Today, we're diving deep into a major biotech shakeup that sent shockwaves through the market. We're talking about uniQure and its Huntington's disease drug, 𝗦𝗢𝗢𝗢𝗓. If you've been watching the stock, you saw the cliff dive, a staggering 57% drop. So, what happened? And what does it mean for the company's future? Let's break it down. The bombshell news came directly from the FDA. In a complete reversal of their previous guidance, they told uniQure that the current phase 1/2 data for 𝗦𝗢𝗢𝗢𝗓 is no longer enough to support an accelerated approval. This is a massive blow, especially since the company had received positive signals from the FDA as recently as November 2024, suggesting they were on the right track. This isn't just a one-off issue, it's part of a worrying trend. We've seen similar surprising rejections for other companies, indicating the FDA is getting much stricter, especially with novel treatments. They're demanding more robust, controlled data and raising the bar for what's considered approvable from early-stage trials. So, where did the original optimism come from? The data itself is actually very promising. The trial demonstrated a 75% reduction in disease progression, a scientifically powerful signal for a devastating illness like Huntington's. Our entire bullish thesis was built on this strong data, combined with what seemed like a clear, FDA-supported path to market. We were projecting a phase 3 trial start in early 2025 and a filing for approval in 2026. This entire timeline is now completely invalidated. To understand the new reality, we had to completely overhaul our financial model. Using a risk-adjusted discounted cash flow analysis, we've made some critical changes. We've slashed the probability of success from 60% down to 35%. We're pushing the potential launch date back by 3 years, from 2027 to 2030. We've also increased the discount rate from 12% to 16% to reflect the higher uncertainty and the almost certain need to raise more money, which dilutes existing shareholders. Finally, we factored in an additional $150 million in R&D costs for the new, larger clinical trial that will now be required. The result? Our price target has been drastically cut from the $35–$40 range down to a new valuation of about $12 to $15 per share. This severe derating aligns, unfortunately, with the market's brutal reaction. What does the road ahead look like? The 5-year forecast has been completely redrawn. 2025 will be a tough year, defined by high financing risk. We expect the company will have to issue more shares to fund its operations, which is never great for the stock price. The main focus will be on getting clear, final guidance from the FDA on the new trial design. Expect high volatility. By 2026, things might stabilize if uniQure can secure that funding and start enrolling patients in the new trial. The story will then shift from survival to execution. The next major inflection point won't come until 2027 or 2028, when we might get interim data from this new study. A positive signal then could be a huge catalyst and start to re-rate the stock. The full, pivotal data is now projected for 2029. If that's successful, it could restore a lot of the company's lost value. This pushes a potential FDA approval and commercial launch all the way out to 2030. Unsurprisingly, this means the company will continue to lose money for the entire 5-year period. The key financial metric to watch won't be earnings, but cash burn and shareholder dilution. So what's the final recommendation? The FDA's decision has fundamentally changed the investment case for uniQure. The stock is now a classic show-me story in the short term. Expect more pain and dilution long term. The science behind 𝗦𝗢𝗢𝗢𝗢𝗢 still compelling. It could be a life-changing therapy, but the path to get there is now much longer, more expensive, and far riskier. For most investors, we recommend a hold. If you have a very high tolerance for risk and a 5+ year time horizon, you could consider a speculative buy. But it's crucial to understand the dangers. For everyone, the key takeaway is this: position. Sizing is everything. The risk profile here has dramatically increased, and your portfolio allocation should reflect that. Thanks for tuning in for this critical update. It's a tough situation, but one that highlights the inherent risks in biotech investing. If you found this analysis helpful, please give this video a like and subscribe for more in-depth reports. See you next time.